Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. Welcome, everyone, to this episode of the Expansive CEO podcast for another Investment Friday. And lucky us, we've got 2 weeks in a row where Brad is here joining us. We're both here. So Brad Haines of Juncture Wealth Strategies, my Chief Investment Officer. How are you doing this week? What's up?
Doing well. Just visiting our headquarters in Arizona here, where as many people are probably very aware that Arizona during the summer is not the coolest place in the world. It's a little warm, and that is fortunately not been too bad this week, but it is definitely on its way to heating up. So
What's the average temperature right now?
I
This
think
is
yesterday
May
was like
6th.
102, 103.
Wait, what?
So 102, 103.
In the middle of May?
Mm-hmm.
Oh, no.
Yeah, so June and July is going to be super fun. August and September as well. But August and September, you have the monsoons come in, and sometimes you get the rain. Sometimes it's just the haboobs, which are full of dust and no rain, which are terrible. But
That's a real word too. If anyone hasn't, if you don't know what a haboob is, HABOOB.
yes,
That's the word. That's the actual word. And it's when like a mile high wall of dust just goes across the desert. And it's pretty crazy. And Arizona has those during monsoon season.
yeah, they do, and it's unfortunate because that's the worst part of the summer in Arizona, the haboobs. Whereas like monsoons are great because it cools everything off, provides a lot of water, and it's a real nice respite from the unbearable heat that you face in the summer. So we're not there yet. So it's still 102, 103, which is pretty manageable in Arizona. So, but we're sitting here mid-May, so we'll see how the summer progresses.
Pretty early. Okay, I'm going to tell. We have story time this podcast, so everyone buckle up. I'm going to tell another story. I have another story planned for a little bit, but this is prompting another story. Last year, when my family and I visited, because my family and my husband's family are all in the Phoenix area, for the like 99% of our family lives there, and we were visiting in the middle of the summer because that's when the kids are off school. We were driving to just a shopping center. We're at a four-way stop, right? There's lights and there's signage around us, right? Think about street signs that are on traffic lights. And when we looked up, the signs or the background is green, the writing is in white. The white writing had melted. Literally melted. You couldn't actually read the street signs. We just knew where we were because we know the area, but all of the street signs, the white had melted off of the sign because the previous summer, which we were also there for that, there was a stretch of 100
110.
yeah, like temperatures over 110 degrees for more than like 2 months.
Yep.
It was absolutely crazy. And when we were there, it was like 118, 120 during the summer. So that I hadn't seen, I am an Arizona girl. I grew up there most of my life. Right. But I had never seen, signage melting over the summer. So that was like, I don't know, it's getting a little crazy out there.
Yeah. The only other time was one of my first summers down here. This is many, many decades ago. And they couldn't land at Sky Harbor Airport because the asphalt was melting underneath. So when the planes came in, the asphalt was so hot that the planes couldn't necessarily land without damaging the runway. So they canceled the landings and you had to be diverted elsewhere. But that's hot.
It's hot.
Just
Yeah.
for
So
anybody if for anybody who thinks it's just a dry heat, come on down anytime you want when it's 120 plus degrees. And I will tell you, dry or not, it is miserable.
Right. Welcome to our oven.
Yes.
So
Yes.
I get that. I get that comment still because I live in Ohio. Tell people I'm from Arizona. They ask, right? So there's the story. I'll just direct everyone to this podcast episode and say that's what it's like to be in Arizona in the summer. So that aside, it is May 16th, the middle of May, when we're recording this. This will come out on May 17th on Friday. And we've actually been hitting some pretty interesting highs, right? On the Dow Jones Industrial Average just topped 40,000 yesterday and today for the first time ever.
Yep.
The S&P 500 was up over 5,300
Correct.
on that index. Closed just slightly lower today on both of those. But yeah, tell us what's going on with the markets.
Yeah. So this has been a fun week. The last couple of weeks, we've had these spike of inflation where inflation had popped up for a couple months and people were very concerned about, you know, not only not cutting interest rates, but possibly having to raise interest rates to offset this resurgence in inflation. And as we and you and I had discussed a lot of times, is I thought the disinflationary trend is in place, but nothing is a straight line, and there are impacts and revisions and seasonalities that come through the data, and you really have to stand back and get a longer term viewpoint of it, and you can still see the disinflationary trend is still very, very in place. And so we'll talk a little bit more about why we think that coming up. But so this week you had CPI, the Consumer Price Index, which is a very popular measure of inflation for the average urban consumer. And it came in weaker than expected. That also then supports some weaker labor market data we've had last week. And so those two data points, well, actually 3 or 4 data points combined together, started to allow the investors to go, wait a minute, maybe the economy is weakening, maybe the labor market is weakening, and maybe the inflationary pressures are dissipating. So what that means is essentially, well, if that's the case, then interest rates will probably be coming down, which means all asset prices, equities, bonds, real estate, commodities should be valued at a higher level based on that impact to their earnings. And so what you have is the equity markets overall, the bond market's doing well, commodities going up, and you have real estate that's come up quite a bit. And so here we are sitting just below our highs. I mean, I don't know if you remember this, but way back when I started in the markets in the 1990s, there was an economist named Harry Dent who wrote a book called The Dow 36,000.
Mm.
And for many, many years, he had some really great points, and it was all based on demographics, long-term demographics of the workforce and the people coming in and exiting the workforce and the size of it and how that impacts the U.S. economy. And for many, many years, he was incorrect. But
Hmm.
again, demographics, very long-term trending. And here we go. I hope Harry Dent feels very good about it. We're at almost 40,000 on the Dow, so good job. You know, he took some hits on that in the early 2000s, so he should sit back and think about his gratification there of being correct.
Only took
But
30 years.
yeah, I mean, it's interesting because interest rates are so important to earnings of companies. Even if there's just a small amount of leverage, interest rates are very impactful. They can be impactful on the asset side of the balance sheet because if, for example, you have a lot of cash, now you can park your cash at 5% versus 0 as earlier. And if you have a lot of debt on the balance sheet, well, is it fixed rate? Is it floating rate? There's a lot of variation in across the economy in terms of balance sheet strength. But as interest rates come down, that's going to put it's going to help a lot of those indebted companies reduce their interest costs. A lot of those happen to be small cap or mid caps companies that have some floating rate or bank loan exposures that as interest rates come down, that's an automatic pop to their earnings. In fact, it may help them going from a loss to actually having earnings. And that change is what investors are now pricing into the market at all-time highs.
So it sounds like we're in one of those bad news is good news cycles.
For sure. For sure. But what's interesting is depending on the company you get, bad news can be really bad news. So it's been interesting in the tech market, if you come in and you have bad news, it's not good news. It's bad for the individual company. But for the market overall, if you get a little bad news about the economy, pretty good news for asset prices.
So interesting to kind of follow and kind of anticipate these moves, right? That where we can see that inverse relationship is pretty like, I don't know if it's one to one, but it feels like it, right? Like, oh, we hear that, inflation is coming down, that wage growth is coming down, right? That's wage growth especially is tough news for consumers, but that's good news for lowering inflation. So up the asset prices go. So yeah, it's really interesting. Let's talk about shelter inflation. It's one of
Okay.
the topics we want to talk about
Yep.
today, right? Because that's one of those big pillars of inflation. So yeah, what's happening there? And what is shelter inflation? Let's define that first.
Okay, so let me take a step back really quick. Um, the CPI indicated a lower or a continued disinflationary trend. Um, what has kept it's still at higher than the Federal Reserve's target of 2%. So what are the underlying contributors to that higher than average inflation or that higher than target inflation? Two main areas have really been the strength there, and one is shelter inflation, and the other one is wage inflation. So shelter inflation is effectively it's the inflation on leases, on home ownership, through an interesting model or estimate of what those rents would be going for homes that are owned, called owner's equivalent rent. And what they do is they try to measure that. And because home prices really since the pandemic have gone up enormously, that has been a very, very durable or persistent source of inflation. Now, shelter inflation itself is starting to decelerate, but it's still at very, very elevated levels. Why do we think it's going to continue to come down in inflation impact? Is because it's very correlated to the new tenants index. And the new tenants index is, okay, what are the rents? What are the new rents being signed? How are they compared to last year's? Are they more, are they less, the same? What percentage? And so effectively, the CPI measures all of consumer real estate, and the new tenant index are just the people that are signing up today or that month. And it's the new tenant index is decelerating a lot. It's coming down in price quite a bit. In fact, Alpine Macro, which is a macroeconomic research firm, and they put out a lot of great research that we rely on here at Juncture. And I'm going to share my screen if you'll allow me to do that.
Yeah, go for it. So if you're watching, if you're listening on Apple or Spotify or anywhere, we're actually looking at a chart here that's super helpful. So if you're watching on YouTube, you're seeing it with us. So we'll try to
Okay. Does it
explain.
show?
Yeah.
Does it show right now? Can you see my?
Yep, we can see
Okay.
that.
So you see in this upper right-hand corner, U.S. average CPI shelter inflation, which is the left scale, which is the LS means left scale. So on this side of the graph, and then the red is the new tenant rent index, which is on the right scale. The RS is right scale. Now, what they did is they advanced that by 10 months because there is a delay for new tenants to come into and be impactful in the shelter inflation rate. So they advanced it, and you can see that the red, it's pretty correlated over many years. That both of those lines are pretty close to each other. And you can see that the red, which is the new tenants index, has fallen pretty precipitously to essentially zero. So in other words, inflation in that environment in the new tenant is zero. There's no more inflation in new tenant index. Now, because it takes a while for that to roll through the rest of the single family homes and apartments and multifamilies, it takes a while. So it can take 6 to 12 months to come through to have this CPI shelter index fall from 6% to roughly around a 0% contributing. Now, shelter inflation is the largest component of the CPI and one of the major components of the PCE, or the Personal Consumptions Index, which is the Federal Reserve's preferred measure. So it's very important that we understand that this is the biggest contributor to inflation being above target. And what we're showing you here, or what Alpine Macro is speculating or concluding, is that shelter inflation will be gone within the next 6 to 12 months, which means our inflation rate 6 to 12 months from now will be much far less than it is today.
And
So
so,
this is one of the things that people were cheering when they bought into stock this week.
okay, so that, yeah, and stay on this one for a second, because I think the chart 14 on the left is important too. But this is again saying that we have experienced, and for people who are just listening and not watching, shelter inflation was at, I mean, that's showing it was at roughly like 12%, right? A couple of years
So
ago.
shelter inflation was about 8 at the peak,
Okay.
little over 8 on the left scale here.
Oh, the
And on the,
new tenant rent index.
yeah, new tenant rent index was around 12 at the peak.
So that would mean, and I remember hearing about this, right? People like renewing rents over and over, like the rent just every single year for several years in a row was going up a lot. You know, it
Yeah,
wasn't a 2 or 3% increase. It was a 5 or 6 or 10% increase. And people were feeling that. And so that's exactly what this graph here, this little snippet is showing, is that we were experiencing that, 5, 10, 12% increase over those years. And now it's coming back down to a 0% increase means it's just leveling out. It
right.
doesn't mean it's
It's
coming
basically
down.
no change year over year.
Yeah.
Okay. So if you're paying $1,000 in rent today, then and there's no change, it means your next lease is $1,000 a month as well. So it's the same. Whereas, like you were saying a year or two ago, it was like if you paid $1,000, all of a sudden it could be, well, now you're paying $1,150 per month instead of 1,000. So that's quite a bit increase in certain markets in certain places. Now, another data point that if you want to look at is Zillow's observed rent index. Okay, which is, again, it surveys a lot, figures out the rents and what is the average change in rents, and you can say it also mimics the new tenant rent index. It mimics it in showing that it has come down from very elevated levels to virtually zero or slightly positive. So again, it's also another trend or another series of data that is that is also supporting the one we just talked about, the new tenants rent index, and saying, hey, there's not a lot of inflation currently in the rental markets. And so how does that flow through? That eventually will flow through to shelter inflation for the CPI and the PCE, which again is the biggest component, which means their biggest leg that they've had for this elevated inflation goes away.
And so here's the question I want to ask. What was the last or most recent number that we saw? Was it around 3.5%?
Oh, for overall, yes.
Overall? Okay. So if that's saying in 6 to 12 months, like this is a big portion of that 3.5%, what does that do you know? Do you know what that kind of forecasts for the
Yeah,
overall
it
number?
implies a 2 to 2.5% inflation rate.
Okay. In 6 to 12 months.
Yep. It really depends on what services does. So if you take out shelter from services, goods inflation right now is virtually zero. Oil prices have popped up a little bit, so they'll have some impact on that, but generally goods inflation is about zero right now. This is telling you that that shelter inflation will be coming down to zero to slightly positive. And then you have the next section, which is services X shelter, which is very dependent on wage growth.
Hmm.
So that's where this other chart to the left, where we talk about, the Atlanta Fed wage growth on the right-hand scale has come, for those of you listening, it's come from almost 7% at its peak. Now it's looking like it's a little over 4.5%. Most likely on the way down, because owner equivalence rent is very, very dependent on the wage growth, and wage growth is dissipating. It's one of the things we had the Conference Board's employment trend index last week. In addition, we had the National Federation of Independent Businesses net hiring survey results come out. Both of those were weaker than expected, saying, hey, there's only 10 to 11% of businesses that are looking to add people.
Hmm.
And so that's down from 35%. Arguably 35% is way too strong. It's why we get in the really tight labor market situations we did. It's why wage inflation got pushed up. Right now, though, those are starting to come off. So you're seeing wage inflation starting to moderate with weaker hiring, with less jobs available. And then now you have shelter inflation again, which is looking like it's going to hit basically zero to slightly positive between now and first quarter of 2025. That means an overall inflation is going to drop into the Fed's target range. Now, one of the things I think Jerome Powell and the Federal Open Market Committee are discussing is, when do we start to lower interest rates? Because once the trend is in the real economy and it's impacting what you and I do on a daily basis and how we spend our money, sometimes we get into a trend and the Federal Reserve can't stop that trend very, very well. It's almost akin to, if you've seen that meme with the large cruise ship that was coming into dock and it came in too fast and it took the dock out, right? Even though it was not coming in super fast, it just has a lot of mass. And so they couldn't stop that before they destroyed the dock and another boat. Well, that's essentially what the US economy is. When the Federal Reserve gives us these hints or these incentives to either save more or spend more, sometimes it gets embedded in consumer behavior, and it's very difficult to encourage us to change that. And it takes some time for everybody to go, wait a minute, You mean you want me to save more right now? Okay, well, we'll start saving more. Well, by the time everyone decides to save more, the economy is slowing to such an impact, the Federal Reserve is like, no, no, we want you now to spend a little more. And it's sometimes it's you're so you want to protect your balance sheet, your household's balance sheet so much that you want to continue saving, even though the Federal Reserve really needs us to get out there and support that economy by going to Walt Disney World.
Right. Done. Check. I did that. Um, well, and to your point, like that could also be another place where lowering interest rates, right? That could help with that as well. If interest rates come down, if those high yield rates that are currently around 4.5 to 5%. So we're actually like, you put money in a savings account and look at that. It actually like grew. Like you can see the effects of that interest. If that goes down, if that's taken away, that's, maybe that little bit of impetus not to like, well, I'm not getting much for that. So either spend that or put it into the equity markets, right? Like buy stocks instead of sitting on cash. All of those different things that can happen as we start to shift. But it's a really good point, and it kind of leads into the other story that I wanted to tell today, that this period reminded me of an experience that I had back in, it was probably 2009. I think it was 2009. It was around like late 2008 or 2009, back when gas prices in the US were extremely high. And so you were saying, a barrel of oil, right, was like 150 plus dollars at that time. Um, and other inflationary factors weren't really creeping up as much. But at the time, I was working for, working at Ameriprise, was working at a big practice. And I was very, very fortunate, that even though I was the one writing all the plans and doing a lot of the back office work of financial planning, I was doing all of that, but I was consistently invited to sit at the table with the advisors, because that allowed me to learn and take in a lot of information and really like be able to then translate that into the plans I was writing for clients. And so I had this very kind of unique experience and unique viewpoint when I'm sitting in a conference room full of advisors talking about inflationary factors. Um, and saying, well, gas doesn't it's not part of the inflation numbers, and groceries, they're not part of the inflation numbers. And so me being the staff person in the room that was making probably a tenth of what a lot of the advisors were making, if not less than that, I raised my hand and I said, that's actually a really important thing that people are experiencing. So like, when gas is $5 a gallon, and for my household, it was going from, I spent $250 a month on gas to drive to work, and instead it was $600 a month to drive to work. That money had to come from somewhere. And so that was a really interesting place to be, right? For me as a I was 24 at the time, to be able to hear the conversation and say, hey, there's like a whole huge swath of the population where this actually does make a huge economic difference. It's not just a blip of a data point. And so I share that because it's one thing that's always stuck with me, even as I've grown, and our household is doing relatively well now. I'd say we're like, solidly at the middle class, upper middle class area. Um, and yet I understand the experience on both sides, and I get to hear the experience of people with ultra high net worth and talk to them and understand that. And I also get to hear the experience of new entrepreneurs that are freaking struggling, and have like there's something in me that is here to like bridge that gap and bridge the experience and understand like multiple sides of what, the way you put it, like the haves and the have-nots. Truly. I mean, that's what we're experiencing right now. And so I wanted to share that story because what reminded me of that was that shelter inflation piece again, right? Where it's such an important factor and everyone. So I'll be 40 this year. I'm like an elder millennial, right? I think millennials are like 28 to 42-ish right now, age wise. And I was also fortunate to be part of the millennial group that was able to buy houses before the spike. So the house we're in right now, we bought in 2018, and houses now, like this house, it would cost us probably about 80% more if we bought it today than we did in 2018, which is huge. And
Yeah,
so
that's massive,
it's such a big shift. And to
particularly with the higher mortgage rates.
right. And so it's the double whammy, right? Because it's like my mortgage rate is like 3.5, and I bought this house for less than $300,000. Now it would be 450 to buy it at 7% interest.
Right.
And so
Exactly.
this um what people are actually experiencing, right? This is the thing. This is like, okay, the shelter inflation has actually been hugely impactful to something I think you're going to talk about in a second here, which is that like replacement, right? Housing has gone up so much. So now that's where our money has to go, for people who bought homes at these higher rates, younger millennials especially, versus like going out to dinner and going on the vacations and buying diamonds and buying, like going and getting coffee every day, right? All the industries that millennials have quote unquote killed. Um, Part of it's the shelter inflation that's been so pervasive over the last, several years.
Yeah. Hey, could you get me to stop sharing my screen? For some reason, I
Yeah,
can't. It won't allow me to stop sharing it. So
I can stop. These are good. These are good screen shares though.
yeah, no, they're great. But uh, so what you were talking about was that substitutive effect of discretionary. You only have a certain amount of discretionary income, and you can only divide it up in so many different ways. And if one area becomes much more expensive than history or typical, you've got to divert funds from other areas, whether it's vacations or cars or where you shop. So right, the difference between what we consider a normal good, which is the good that you would want to buy, versus an inferior good. It doesn't mean it's bad quality. It just means inferior good means you would prefer not to purchase that one, but you would if you had financial constraints. So you see people, in particularly the last 2 to 3 years, you've seen a big swath of people um, start to go towards those inferior goods. So instead of shopping at Kohl's or Target, they're shopping at Walmart. Walmart today just crushed their earnings,
Mm,
um, because people are looking for the best deal on groceries, clothes, and all the different things that they provide at as low cost as you can probably find in the economy. Um, is it people's favorite place to go to buy? Absolutely not. I don't know one person that really likes to go to Walmart, with the exception of the prices. They love Walmart prices, right? And so when times get tough, people veer towards that area. Whereas when times are really, really good, inflation's low, they'll shop. They don't really care where they shop to buy their stuff. Um, so it your experience with the oil prices and the gas prices is very telling, because that is exactly what's happening with a whole young generation when it comes to single family homes right now. We've talked a lot about in the past of why did mortgage rates go from essentially 2 to 3% to 7%, over 7%, and yet prices of single family homes haven't dropped that much, if at
right.
all. Okay, why is that? Well, a lot of that has to do with real estate investment trusts and private equity funds, these very large institutional cash buyers for single family homes, they come in and they basically crowd out the young family or the young person that wants to buy a condo or a starter home. Whereas they come in with cash, they pay all cash, and then they rent that home to someone who can't afford to buy. Honestly, that I think that is there has to be a legislative solution to that problem, because I think it widens the wealth disparity in this country, by allowing the wealthy individuals who invest in real estate investment trusts and private equity funds to benefit by renting to people who can't afford to buy. And so they create a rental class of individuals who may not have the income where they can save up 20% of $500,000 for a home, right? That takes a long time. It takes a lot of effort. And how many individuals who are young and professional have that type of ability to do that? I don't know. It'll be an interesting dynamic as things go about, but it is constraining spending in a lot of different areas. So that said, private final sales spent or consumer spending has been pretty much break even for the last couple of quarters. So not break even, its growth has not grown, but it's still growing at roughly the same rate over the last 3 quarters. So that's a good sign that the economy isn't slowing to such an extent that we need to worry about it, but it is stable, but yet probably declining a little bit as we go on in terms of overall economic growth.
So I think as you were talking about that, what was kind of coming up for me was this feeling of like we rely so heavily, the US economy relies so heavily on consumer spending, right? That's basically like, I don't know, you know the percentage. What percentage of that is GDP?
2/3.
Two-thirds of GDP is American consumer spending. So that's us opening our wallets, going out, buying things, right? And there are certain times of year where that is higher and lower and different things like that. So we've got, school coming up. That's always a big consumer spending time. You've got the holidays, big consumer spending time. Um, and I'm really curious to see kind of what politically, right, when we're talking about legislation and different things, that it does feel like there needs to be some movement in the next, 5 to 10 years to support, if we're going to support consumer spending, those, people are displacing their income by having to pay for really expensive childcare, having to pay for really expensive housing relative to what it's been historically, right?
Right.
Even education, right? Like these places where inflation has been much higher than average CPI is where especially younger families are having to spend large portions, large percentages of their income. And if we can find ways to support that legislatively, I think that's where, I don't know, I'm going to go out on a limb and say I think that's how we like keep the economy growing versus, starting it, feeling an actual contraction, because we haven't had the recession, right? That's
No.
been kind of called for a couple of years now. We haven't seen it in GDP.
Yeah, it's one of the things that I warned people about when they talked about the inversion this time, and when they talked about the leading economic indicators being negative for so long, is I said the leading economic indicators don't necessarily directly incorporate consumer spending or consumer health of that spending in those forecasts. So they may be missing the major piece of this particular period of time in terms of that. So I do think we slow down, but I just don't think we slow down enough to get a recession. At least at this point, I don't think we're going to get a recession. Although the impact of fiscal stimulus last year is now dissipating quite a bit this year. So again, it's that solid consumer, less fiscal policy, you have slowing GDP growth. So, but I just don't see it having the conditions where things would go into kind of a tailspin and have a much more severe downturn. You know, I guess there's always extraordinary events that can happen. Those are always a possibility, not a very high probability, but they are definitely a possibility. And
Mhm.
so you never want to get too comfortable.
Don't get cocky.
No, don't. The financial markets, if you want to get cocky, just wait a day.
Right.
They will
Yeah.
humble you very quickly.
Yes. Yeah. I think the best financial managers are humble.
Yeah, we have to be.
Have to be. Well, I think that is a great place to wrap it up for this week. If any of this sparked any conversation or if anything was interesting, I truly love hearing people's comments and I get them. I get them pretty often. Like, hey, I listened to this and it was like really awesome. I shared it with this person, all of that. I love that. I love hearing your experience of, what you're learning here with us. So if you want to share that with me or share any questions, you can get me at Hannah, HANNAH, at expansiveceo.com. Send me any of your questions there or on social media if you follow me anywhere. And Brad, where can people get a hold of you?
You can get a hold of me at my email, which is bhaines, BHAINES, at juncturewealth.com. Or you can give our office a call at 480-253-4100.
And I forgot to say this earlier, but so this is coming out May 17th, tomorrow. On May 24th, Brad and I will be going live and talking about risk in a webinar that is open to anyone who wants to come learn more, ask questions. So we're going to be talking about different kinds of risk, but we would absolutely love, again, to have your live participation. Raise your hand, ask your questions. We absolutely love interaction in that way. So the link is to sorry, you can register at Eventbrite. So we'll have the link to that in the show notes, and we'll share that widely as well. So if that's something that you'd like to do, that's next Friday, May 24th, from 2 to 3 p.m. Eastern time. So come join us live. We would love to see you there.
Yeah, looking forward to it. I'm even going to wear a tie for everyone. So
Oh my gosh.
kind of a big deal. I know it's a big deal.
You're going to make me
So
dress up? I don't want to dress up.
you don't have to dress up. I just said I would.
All right. Well, we hope to see you there next week. And thanks, everyone. And thank you, Brad.
Thanks.
That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.